And what's crazy is it wasn't their money. It's your money.
Right.
So,
out of curiosity.
They gave you a toaster in the old days.
Yeah.
To let you know you're going to get burned. And then last time I went in, they like, here's your lollipop, sucker.
Oh,
I mean, but they
That's why they give those out?
Yeah, exactly, because
Oh,
you're a sucker. They're in the business of cash flow. That's what banks do. They're in the business of cash flow. And think about their returns. It's pretty substantial because just next time you walk into the bank, look at what the rates are that they're paying you. And then look at the other side of the wall and they'll tell what they're charging you. So they're saying, cool, we're paying you 1%. And we have a great deal on a 4% mortgage today.
But it's way better than that.
Right, but check, right, I don't want to get too down, yeah. But so that's not a 3% return, by the way. If you're buying supplements for $1 and selling them for $4, what's your rate of return on that? Hundreds of percent. Now, if they did the same thing that they tell the average investor to do, they would go bankrupt quickly, which is put money in a 401k, an IRA, or a simple, because there's zero cash flow mechanism to that. What they're doing is trying to convince you to pay them back quicker, biweekly payments. A lower, like how insane is it? It's a lower interest rate on a 15-year than a 30-year mortgage typically, right? But they just told you it's better for you because you're going to save all this interest. But see, we always are financing, whether you pay cash or whether you borrow. If you borrow, you pay them the finance charge. If you pay cash, you forfeit the right to earn interest. Either way, there's always an interest cost. It's easier to see what the interest we pay rather than the interest we lose, but this is where a lot of wealth is transferred and where there's a huge amount of wealth lost. And what if you could only, earn 4%, but you only had to pay 3%? This is why banks are in business, because they're saying, hey, Stova, I'll give you 1% if you put money in here. And on the other side of the wall, they go, and if you want any money back, we're just going to charge you 4% to borrow it. I mean, that's a really good rate of return for them because
it makes me so uneasy hearing this every time we talk about it.
We just spoil your life every day. This is why you need to go to Paris for a vacation.
I'm ruined.
And what's crazy is it wasn't their money. It's your money.
Right.
So,
out of curiosity.
They gave you a toaster in the old days.
Yeah.
To let you know you're going to get burned. And then last time I went in, they're like, here's your lollipop, sucker. But they
That's
pause
why they give those out?
Yeah, exactly, because you're a
man.
sucker. What the bank tells you it takes money to make money, what they really mean is it takes your money for them to make money. If you follow the advice I'm about to give you, you can cut out the bank as your middleman, and you can boost your returns 400 to 800%, all while saving on tax. So you're tired of the bank telling you one thing while they do the exact opposite and make money on your money? You know that you can cut out the bank right now where they're taking your money, they're earning interest on that money because they pay you a small amount and then they rent that out for a lot more. And even where they put their reserves, so they get better returns than kind of the reserve accounts, but they have different insurance structures. Well, you can do the same thing with your reserves and with your cash. This means it doesn't take their money to make money. The markup is so substantial, if they're renting it for 2%, let's say you can go to an internet bank, get 2% on your money, and they sell it for 4%, that is a 100% markup. If I get a hammer for $2 and I sell it for $4, that's a 100% markup. So it's not a 2% rate of return. They're paying, let's say, $2 for every $100 they borrow, and they're selling that money for $4. That's amazing, right? That's a great return. Not trying to go from 7% to 10% by taking more risk, but looking at these rules completely different.
When all of this was happening with the economy and interest rates were being lowered by the government, I called the bank just out of...
the Fed lowered it, which is not the government.
Yes,
it's a private entity.
FYI, but brilliantly named.
Yes.
So we feel like it's the government.
So with the interest rates being lowered, I called the bank because I'm like, it's 0%. I wonder how that's impacted the percentages. And
they became more profitable.
It was like 8, 9, 10%. And I was like, they're not transferring that quote unquote discount to the people. Why?
They don't.
They just they got access to money
at a much cheaper rate, and they're charging everybody else an asinine percentage still. Not everybody, but a lot
of them moved
people.
into an infinite territory. The Fed rate is 0 to 0.25%. Mm-hmm. If you'll give me an asset for $0 and I can charge someone 4% profit on that, what's my rate of return?
Where's the accountability to the system?
It's infinite.
Look at stuff that we just
We're going to get you drinking by the end of the day. We're going to have to do wine tasting for you or something.
I might need a glass of whiskey by the end of this. No, I'm kidding.
So a bank, when they look at loans, are more interested in cash flow than they are in interest rates. They want us to be focused on the interest rates, not the cash flow. So they'll say, we'll see that all the time, right? 30-year mortgage, 3.75%, and then a 15-year mortgage, 3.5%. So they want us to give them their cash flow back faster. We need to kind of flip the table on them and do it opposite. So a quick way that we've developed to do that is to take the total amount you owe on a loan divided by your minimum monthly payment. That will give you a cash flow index score. Any scores that are 50 or below are really in the bank's favor. They're kind of destructive to you on your cash flow. It means you have not leveraged very much cash, but it's costing you a ton of your monthly cash flow to keep that leveraged. Any loans that are kind of 50 to about 100, we say usually you can refinance or do something about that loan, restructure it, find a different way to borrow that money and be more efficient. Any loan that scores better than 100, we consider to be a very efficient loan.
A lot of people collapse two terms, loans and debt.
Yeah.
That anytime we owe something, most people just refer that to as debt. And when we have a notion that do everything you can to get out of debt or avoid debt like the plague, like we wrote about in Killing Sacred Cows, well, if you owe money, that doesn't necessarily mean you're in debt. If you have an asset attached to it that's worth more, like he does in both cases, he's got a home that's worth more than the loan. So he could liquidate both of these and end up with money in his pocket. That's called equity.
Yeah.
But most financial people say, well, you're in debt. No, you're not. You're in equity, but you have a loan. So there's a difference between efficient loans and inefficient loans.
Yep.
And destructive loans. Destructive loans are you owe something like a credit card. There's no asset attached to it or no hope for future income from it. But then you have, assets that might have a loan against them that create more cash flow than that loan costs. That's actually a pretty efficient and very productive type of loan. But not a lot of people can handle having a loan and create production with it. Because we've been trained, taught, and educated to consume, to borrow to consume, and banks don't borrow to consume.
Nope.
If they were to borrow to consume, they go out of business very quickly.
Look, you can either make the bank more money or make that money yourself. That's what cash flow banking is about. Using a bank to save your money, it isn't making you wealthy. The banks put their reserves or a portion of their reserves in cash value insurance that's designed with high cash and low commission. Don't stay poor, don't make them rich. If you cut out the banks as the middleman, you get to earn that interest. You get to keep that. You get the tax advantage without locking your money away. It's time for you to earn interest rather than pay it. Don't rely on banks to lend you money. Build your own family bank.
For those who haven't read your book, what is a family bank?
Okay, so what would the Rockefellers do is looking at what banks have been doing with their reserves for a long time. There's something called bank-owned life insurance. And so they take their reserves and they put a percentage of those reserves into cash value insurance plans. But these are high cash, low commission types of plans. And they do it with their executives. And that way they're earning interest without paying tax on that. Well, it's inside of that plan. It's higher interest rate than what they're getting in their savings accounts through dividends. And so the concept here is how can you create a minimum guaranteed interest rate? How can you have access to your money before 59.5 with zero penalty? As a matter of fact, get access to that money very quickly, right? Yeah. How can you add a multitude of benefits that if you became disabled, the payments would still happen into this cash plan without you making that payment after 6 months? Or if you needed to go to a long-term care facility in your later ages, that you could tap into the death benefit while you're alive, not just after you're dead. And ultimately, the goal for me is how do we help you build more cash flow and buy your net worth? That's why I call it cash flow banking, because we're looking at you could start financing things yourself and paying interest. You could pay for, kids' education. Instead of going to getting a student loan, you could, finance their mortgage and you get paid the interest rather than a bank. And so it starts to be ways that you can operate and act like a bank, and you're not subject to, oh, well, right now lending is really restrictive because it's a recession, or, having access to your money versus having it all tied up in plans that have a whole bunch of fees and have a ton of, just make it onerous to get access to.
Can I really use my own bank and set up a family bank for the future? Well, if you live in the United States or Canada, here's some tricks you can use. This is gonna help you create more liquidity, it's gonna help you recover more cash, and it's completely legal. As a matter of fact, it's not only legal, it's like a moral obligation if you want to keep more of your money. So I call it cash flow banking. Cash flow banking is a banking alternative that actually pays interest. It's a structure to save you on insurance costs. For example, people are paying for term life insurance and only 1.1% of that ever pays out. So if they don't die, money's gone. Long-term care. people paying for these policies, and then if they have 2 activities they can't perform with daily living, they can go into a facility, and there's an insurance cost of that. And you know what? There's other things, like there's ways you can save taxes without locking your money away for years, like retirement plans. There's other benefits from cutting out the bank and doing exactly what they do with their reserves. You can easily outperform the measly interest paid by the banks. The way you do this, you can save money in a permanent, overfunded whole life insurance product and coordinate those savings with all of your money-making decisions. You can use your own money instead of the bank's money. And you can set up a loan scenario where you're in control of your payback periods and you can use your cash. The bank is making bank from your money. They're getting triple-digit returns you'll never see yourself if you continue to invest through them. You know, rather than being used by the institutions, use the institutions. Look at what their rules are. They want your money all the time. They want to hold on to it for as long as possible and give it back the least possible. They want you to accumulate while they create cash flow. First off, with cash flow banking, you have tax benefits, which are called FIFO, first in, first out. The first dollars you put in, you get to take back out tax-free first. They give you your interest last. Not many things do that. It's tax deferred, and when you go to take it out, you can borrow that money to avoid tax, or if you take withdrawals, you get your first dollars back tax-free. And if there's an outstanding loan, when you die, it's subtracted from the death benefit and remains income tax-free. So that's a myriad of tax benefits. The next piece is there's provisions on cash flow banking and cash flow insurance called waiver of premium. If you're disabled longer than 6 months, they keep making the deposits for you. The accelerated benefit, where it allows you for long-term care, you can tap into that. That means you might eliminate those other costs and boost your returns. The cash value is protected in over 40 states from lawsuits and bankruptcy completely, and in all states, partially. And one of the hacks is just sign in a state that's fully protected and go there when you get your policy. You don't have to pay for term insurance because you now have a permanent death benefit policy that will be around 1 day longer than you, which means you have tax-free money coming in. I call that buying your net worth rather than trying to build it. Once you find that money, let's move it from a 1% to 2% taxable and double or maybe quadruple what you're getting inside of cash value. So you take the money that's going to the wealth capture account and automatically have it moved or transferred to what's called an overfunded cash flow insurance policy. There's a lot of crappy insurance policies out there. It takes years before you start seeing your cash. They're high commission and they're low cash. You got to eliminate those. You got to find the certified specialist. See, because once you get the policy designed right and you've got money in your control, you can now invest in the right opportunities when they come up. You can use your cash to invest in yourself. I did this multiple times with my cash value. With Killing Sacred Cows, my book, I took $66,000 out and bought remnant rates so I could have Wall Street Journal ads and New York Times ads, which those would have been a 6-figure cost, but because I had access to cash early, saved me money. Or I put in a production studio like what you see here so I could film videos. I used real estate down payments for my cash values and paid them back with the cash flow from the real estate. I bought a business back in 2014 with my cash values. And even in 2010, right after the recession, I paid off high interest rate credit cards because I had a PR firm and a lot of expenses that were coming up with Killing Sacred Cows from my cash value, saving interest and utilizing my own cash flow banking system. If you utilize cash flow banking and you get everything properly set up, you'll be able to pay for your kids' college or pay off loans and debt. See, remember to consider the risks and only invest in things you know. When you're investing in things that are highly speculative and volatile, you know, that may or may not work out. This has a lot more stability.
Find companies that are over 100 years old. I prefer mutual companies, meaning they're not traded on the public stock exchange, so they're not spreading dividends amongst policyholders and stockholders and not having to make really short-term decisions. I want to see a minimum guaranteed interest rate of somewhere around 4%. I want to see multi-billion dollar companies. I want to see all A ratings. I want to see where I can put flexible amounts of money above the minimum. That's the overfunding that can help fuel the cash to be, it doesn't pay as much commission, so it might not be as enticing to some of the agents that are selling it, but it's going to be a great situation for the individual because what we're trying to do is mimic how does bank-owned life insurance work? How would the Rockefellers have designed it? They didn't have to go and pay commission. They just get privately built. There's another thing called private placement life insurance, but usually you got to have $1 million a year that you're putting in for private placement.
Yeah, that's a lot of cash.
That means not a lot of people,
right?
are going to be able to do that. So we're trying to mimic what's the closest thing we can do with something that's available to pretty much everybody, and it's just in the design. So I've given a little bit of the criteria. The overfunding is what's called PUA, paid up additions, that you're putting more cash in. It's available as soon as it's in there. You can borrow it, which means that they use your money as collateral and give you their money. And then you still earn interest, right? But you have to pay interest to get access to that cash. Or you could take a withdrawal. I usually borrow because I want to pay it back.
Yeah.
And if I don't pay that loan back, it just gets subtracted from the death benefit, and the rest comes back into the family bank, into the family estate plan. So have the family office. I look to be really efficient. Instead of overpaying tax, I'm putting money in my cash value. Instead of speculating in the market, I'm putting money into cash value. When there's distress or opportunity, I can pull the money out of the cash and invest and then put it back in. I can finance things, if I just take a withdrawal, or I could borrow and I'm still earning versus what I'm paying. And I just, have a lot of options that way. And nobody's going to deny me the loan because it's my money that's set up as collateral.
When you give the bank your money, they turn around and lend it out. So the first thing you could do is you can get a guaranteed rate of return paying off your loans that have a higher interest rate than what you're earning. So where could you get this? Number one, maybe you could look at your 401k. Your 401k gives you some borrowing provisions that if you borrow that cash at a lower interest rate than what you're currently paying to a bank, then that's going to save you money. Or maybe you have cash values of life insurance. A lot of times you can get that money out, pay off a loan that has a higher interest rate, once again guaranteeing a better situation for you. Or like my buddy Mike, you can look at your savings accounts, your certificate of deposits, or any other type of savings vehicle, cash those out to pay off higher interest rate loans. We're talking about guaranteed improvement. The second thing is something called cash flow banking. So if we look at the world of banking, there's something called BOLI, B-O-L-I, bank-owned life insurance. Bank-owned life insurance is where they put part of their reserves. Now, the reason they put their reserves in bank-owned life insurance is because it has really high cash value. It's properly designed for the banks where when they put their reserves there, it's going to earn a higher interest rate than the normal reserve account. It's going to have tax advantages over the normal reserve account, so it's going to improve their situation. But if you're going to do this individually, you have to design it properly. Unfortunately, a lot of cash value type policies out there have far too much commission and not enough cash. You have to make sure that there's flexibility, that you can put extra cash into it, that there's less commission. So ultimately, you get a situation where when you're putting money into here, it's going to be a much higher rate of return than your savings account, your CDs, or those types of things, but you still have access to that money over time. And it's something you can put more or less in if you design it properly to be flexible. And once you earn a dividend inside of there, it becomes guaranteed, so it's not subject or predicated to what happens in the stock market. You have access to that money along the way. And if you take a withdrawal, there's something called FIFO, first in, first out. So if I put money into a cash value policy, I've overfunded it to be above what the minimum premium is that's all commissionable, so it has more cash richness to it. I can take the money out tax-free just in a withdrawal for every dollar I put in. FIFO is first dollars in, first dollars out. I don't have to pay tax until I got all my principal back and I'm into the interest. But even then, I can borrow based upon how much is in the cash value. It doesn't matter my credit. That company will give me that cash based upon my cash as collateral. It's going to charge the same interest rate or a similar interest rate, so I can still earn interest in there. And if I never pay that cash value back, the death benefit would come in tax-free and pay it off when I die because there is no specific payback provisions. So number one, I've got tax benefits. Number two, I've got minimum guarantees on the interest that I'm earning in there, just like the banks are on their reserves, right? I can use that money along the way if there's better opportunities that come along, which is great. And it can be protected from liability and bankruptcy. This is something you do in Canada. This is something you do in the United States. And in 40 plus states in the United States, it's fully protected from bankruptcy and liability. So it's got a great structure of where you're saving your money. You can utilize it along the way. And if you fund it properly, you're going to see high cash value really early on. Now, if you want to figure out how to do this for yourself, there's a great resource at cashflowbanking.com. You can read up on it. You can even schedule a complimentary meeting with it, and you'll see I even endorse on that side. I'm talking about what I've done with it in my own life because I started out with a mere $50 a month going into this when I was 19 years old. $50 a month, and then a couple years later I was doing $262 a month, and now I'm doing a lot more than that, so you can set up more policies as time goes on. I've even got policies on my kids, I've got a policy on my wife, I've got policies on employees, and I've used this cash to put down payments on real estate, put in a TV studio where I could do filming, put in full-page ads for Wall Street Journal and New York Times when I did Killing Sacred Cows, pay off high interest rate, loans, and even buy a company with it. So that money's available. It's not locked up like other retirement plans. And now you're building your own bank. Now, the third thing to mention here is you could make money on the buy. So the first thing we talked about was what I call reallocation. Taking underperforming assets and paying off higher interest rate loans if that applies to you. That's a guaranteed return. Number 2 is building your own cash flow banking system. Go to cashflowbanking.com. But third is, when it comes to investing, how can you make money on the buy? This is more active investing, but let's look at it. How can you lend money like the bank? I have a friend, I went to college with him, we actually roommates, and his mom and dad, when I was first starting in financial services, decided to meet with me just to do him a favor. He was gonna buy a home, his older brother was gonna buy a home, and his parents had a bunch of money in CDs that weren't paying very much and they were taxable. So what we ended up doing is have them become the lender, and they actually bought the homes, and they charged an interest rate to their sons that were actually higher than what they were earning from the bank, but for their sons was lower than what they would pay the bank. Once again, cutting out the middleman. So they had the collateral of the home, they're helping out their kids, and they're seeing a higher return for them and saving their kids money. That's a win-win-win. So that was really cool. So there's even situations where I've had some clients where they were buying a home for their mom, right? And what they did was they used their credit in order to get it because they had a private bank or a portfolio bank where they were able to get 2.6% interest, where their mom would have had to pay 4.5%. So what did they do? They split the difference. They charged her 3.5%. The loan was in their name. She paid a little bit more to them, so they cash flowed every month. She saved money going through them versus going through the bank. They made money just using their credit. Now, there's other ways you can act like a bank here. There's things called hard money loans or bridge loans, where there's people that are going to acquire something and they haven't secured long-term financing because maybe they're buying it, it's a really good deal, and they need cash really quick. So you could charge them points when you lend to them. Maybe you're buying a piece of real estate, you charge them something right up front, plus charge them a higher interest rate than from the bank, and then they refinance that with the bank once they've secured that. When I bought my cabin a year ago, by having the cash, I was able to negotiate a better price. That happens a lot of times. So I was able to just pull this from my cash flow banking system and buy it and save a little bit of money, plus get the home when 2 other people are trying to get loans, right? I already had secured the cash. I used to have a hard money lending fund back in the day where we'd go in and we would finance projects in the interim until they could secure long-term financing. So what you might consider doing is using cash flow banking, sitting in cash, and the way you make money on the buy is you look for people in a distressed situation. People that need to sell a business quickly, or people that need to sell a property quickly because they have a cash flow crunch, or they're moving somewhere, or for whatever reason, those are the people that are usually willing to sell at a deep discount because it helps them solve that problem quickly. That's what I mean by making money on the buy. Part of the way you could do that is you wait for recessions to come, and then during those recessions, companies get a lower valuation, even though they might still be an amazing company, but the entire market takes a hit. Or you look at when the real estate market goes down and you can buy something that's going to cash flow from day one versus a time where it just runs up and it's a lot more expensive. So what could you do to get something at a discount because you have buying power, maybe using your cash flow banking system, or a crazy situation where someone's distressed, or a type of recession where now cash becomes amazing to get the return from day one. That could even be buying a business that cash flows from day one.
Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.